welcome back to my channel. So today's video is all about chart questions I ask before I ever enter into a trade. Now the reason that this is so important is that it's all about eliminating bad trades before money is ever placed at risk. Anytime you have those internal thoughts in your head and you ask questions, that acts as its own system. So if the chart can't answer them correctly, the trade should be disqualified and invalidated with no exceptions. So hopefully this video can provide you some clarity, especially if you're new to trading. So y'all can see here I have NVIDIA pulled up here on the chart, and I'm on the 2-minute time frame as well. Now definitely keep in mind that this approach that I'm going to go over is especially essential for new traders because early losses, they rarely come from market randomness. They usually come from entering trades with unanswered questions, and you may just be hoping that price behavior fills the gaps later, and typically it just doesn't play out that way. So that's why it's always best to ask yourself these questions so that you don't have to run the risk of losing too much of your capital. Okay, so let's just jump right into it. The first question that you should always ask is, where is price located within the market structure? Now, I frequently hear new traders often believe that more trades equal more opportunity, and then fast entries will equal their edge in the market. But in all actuality, this is not true at all. And it's no fault to anyone who's brand new to it, but just understand that things like indicators don't 100% equal confirmation. One of the main factors that you can actually rely on is price action. So if you know how to read the charts, this will help you develop your strategy much faster. Because one of the worst things that you can do is ignore structure, the context, and the risk definition. Now, within understanding any type of market structure, you always want to pay attention to the fact that rooted in how price always moves is going to be supply and demand, participation in terms of volume, and positioning. And that'll help you ensure that none of these concepts get old. So for me personally, before anything else, I always ask myself, is price trending in any certain direction? Is it ranging or is it transitioning? This determines everything. And the reason why it matters is that trend strategies can often fail in certain ranges, and range strategies can fail in certain trends. So sometimes transition phases will cause fake signals, and I'm going to give y'all plenty of examples within this video. But one of the most basic price structures that you can pretty much always rely on is that if you see the stock is making higher highs or higher lows, trend continuation will logically apply, just depending on the range and when the stock becomes exhausted. So if you're stuck between two levels, breakout patience is required. Hence why you'll see the consolidation, and we're going to talk about it in this zone here. Alright, so let's go ahead and break this down. We can clearly see here at the start of the market, NVIDIA opened with some bearish sentiment. From there, we see that the buyers actually took over, but it was short-lived and very brief because we can see sellers took back over control here at 8:42. Now from here, we can see that there was sort of like a tug of war between buyers and sellers because for the most part, between these 2 minutes of time, buyers and sellers pretty much were playing a game on who has the control. There was brief moments of bearish sentiment followed by some bullish sentiment, and this continued for over an hour in the market. Now ultimately, the stock reached its low for the day at 9:42 a.m. And ironically, this was a candle that closed with bullish sentiment. Now, would this have been the perfect clue that buyers would take over? Not necessarily, but it definitely pinpoints the structural move of the market, all because the chart never confirmed expansion to the downside. So remember, market structure always comes first, and trades only occur after structure confirms your analysis. So what this basically means is that you want to look for disqualifying examples. An easy one to pinpoint here is going to be at 8:52. This would have been considered a breakout candle for those who are analyzing the charts in real time. However, if a trader enters a breakout long while price is still below a clearly defined range of high, the market rejects the level and rotates it even lower, as we can see here. Now the result for anyone who would have falsely believed this was a breakout would have been break even or a loss in capital at worst. So that's why it's always important to ask yourself, who is likely active at this level, buyers or sellers? And if you don't have a clear definitive answer to that, it's best to just wait it out because large participants transact at specific prices, and these zones will always leave traction. So it could be a strong reaction, it could be a fast rejection, it could even be volume expansion. But I do want to pinpoint one specific candle that does separate from the rest. This candle here at 10:26 a.m. Now after NVIDIA reached its low for the day, it did go ahead and rally into an uptrend. It wasn't a massive breakout into the uptrend because clearly we can see the steady momentum, and the motion of the candles was kind of like a stair-step pattern with a few dips here and there as an exception. But when we go ahead and take a look at this candle here at 1026, we can see that comparatively that the body is much larger than the two candles from the previous 4 minutes. Now, although this is a bearish candle, true enough, in my opinion, there's nothing at all bearish about this candle. Now, I know that may not make total sense when you look at it, but if you've been trading a while, you can break down the anatomy of a candle and understand that although this is bearish, in reality, the underlying sentiment is actually very bullish. At least that's how I interpret it. Now, the reason I say that is because this candle opened here at about $185 in that range. Yet and still, within 2 minutes of time, sellers pushed the price all the way down to the low of about $184 in this range. However, that still was not enough pressure in order for it to close in this range down here, because buyers actually pushed the price all the way back up to close at the $185 range here. So essentially what this sums up to mean is that sellers pushed the price down, but buyers aggressively stepped back in and forced it back up before the close. Hence why, in my mind, this is not a bearish candle, because there's way too much buying pressure here at this bottom wick. Now, some may justify it differently, but again, this overwhelming amount of buying pressure is much too significant to ignore. So if we were to watch this play out in real time, this would have been a great clue to let sellers know that buyers were in extreme control at this time. And because the sentiment hadn't totally shifted, the next candle that played out with this small selling pressure didn't have much weight to back it. Hence why the following candle was extremely bullish, and that's relative to the candle here at 1028. Now, sellers put up a good fight here at 1032, however, it just wasn't enough. So again, if you're analyzing this in real time, you can see that this selling pressure is just not powerful enough to overwhelm the buyers. And one reason is because the body of these bearish candles is not very extended at all. For this candle here at 1032, same thing at 1028, and the body at 1026 in comparison to the wick. So there would never be a need to justify this as bearish sentiment in my mind. Now this is confirmed because every single candle that followed after the 1034 mark presented more and more bullish pressure to the upside, up into the ultimate high here at 10:56 a.m. And at this point, the trend ultimately became exhausted. And this goes back to the question of who is likely active at this level, buyers or sellers. Because it's good to know that trades should only be acceptable to you if the entry occurs away from the opposing zone, or after price reclaims the zone with acceptance. So I hope that makes sense. Buyers just completely had way too much momentum. Now, another question that I think is super important to ask yourself before entering into any trade is, what is the risk in dollars before the reward? One of the factors that I always make sure I have new traders consider is the fact that I never enter a trade without knowing 3 things. 1, the exact invalidation level, if it is to be reached, the specific dollar risk that's associated with this, and then the position size that's tied to that risk. All of these factors must tailor into why you're choosing to enter the trade. This is where discipline will separate professionals from hopeful traders. Because in all realness, the market is only going to reward those who pay attention and understand the variables that make up market structure, that will drive the stock into a rally or sell-off. So the easiest way, in my opinion, to disqualify any sort of trade is to look at the risk profile. So for example, if the chart offers a clear setup and it appears to be a breakout, structure has to confirm it first. Because if not, it'll just lead to drawdown. And for me personally, if the chart can't offer that assurance, the trade is completely ignored on my end. So anytime you're looking at it, it's always best to at least have a minimum of a 2-to-1 reward relative to your risk to qualify a trade to be acceptable, because that math will check out. But if you were to reverse it and have a 1-to-2 ratio, depending on how many trades you take and your win rate, you may just be setting yourself up for failure. Alright, so the next question that I always want to make sure that I have traders fully understand, I'm going to go ahead and pull up Tesla to show you this example. And the question that's presented here is going to be, is volume confirming or contradicting the price move? Now, of course, we know Tesla is extremely volatile. So price without volume in some cases can lead to vulnerability. So a good rule to stand by is questioning whether or not participation is expanding in the direction of the trade. Now, this has several factors that can come into play. But ultimately, why it matters is that breakouts without volume often fail. And on the other hand, reversals without volume can often lack follow-through. So an example of this is if price breaks a level of resistance but volume contracts, the outcome is typically going to be a false breakout, because you'll generally see an immediate retracement of the level, and that can either lead to 1 or 2 things: a consolidation zone or buyers and sellers competing at a high level. So with that in mind, it's always good to see volume expand on breakouts or contract on pullbacks, because this will allow you to see the alignment with directional intent. Now, I'm fully aware some people trade without even using volume, and that's totally fine to do. But for those who like to have that vantage point of viewing the participation in the market, it does play in your favor to read it accurately. Okay, so the next question that I always make sure I ask myself before I enter into any trade is, what is the time context of the trade? Because every single trade will always exist inside time. So the most basic question that you can ask yourself is this a scalp, intraday continuation, or a multi-day swing structure? And if that's the case, does the specific time frame you're looking at, does it support any option contract duration that you're choosing to trade? Now, why this matters is that many losses come from time frame mismatch, not necessarily bad analysis. Because on various time frames, you'll get various perspectives, and it likely will change the sentiment completely. That's why it's always good practice to make sure you're verifying what you see on multiple time frames. If it checks out on one, continue to make sure you're looking at it from various viewpoints. That way, the highest level of confirmation is provided to you without having to guess. Because one thing that can disqualify a trade altogether is, let's say you're looking at the 5-minute and you see the market has bullish outlook. If you enter with same-day expiration on the contracts, the structure needs to play out for the result to go in your favor. But if the stock falls into a downtrend and you chose short-dated DTE, the option can easily expire worthless. So you always want to match your time frame to the specific expected move and the duration of your trade. And honestly, there's really no exceptions to this, because that's really where all your profit can be collected, or you can be unfortunately giving it back to the market. All right, so another question that I like to focus on before entering into any trade is, what would invalidate this trade immediately? If I can't answer this clearly, I never enter into a trade, because the market should only speak to high probability. Invalidations will protect your capital, but you have to recognize them early. And like I always say, hope is definitely not a strategy, y'all. Confirmation will enforce the accountability on that. So for example, if you've ever entered long on a trade with no defined validation, the stock may actually be choppy. And during consolidating markets, the premium erodes, so the loss may hit home much faster. So an easy way to fix this is to always look for things that are invalid on the charts. Now, some may have the opposite perspective by looking for specific levels of confirmation. But if you can identify specific factors that cause a trade to be inaccurate, it makes it super easy and visible to spot it on a chart, because that's much more of an objective way of looking at it. And then also factoring in any type of hesitation, because for me, with one missing answer, it disqualifies the entire trade altogether. And that's simply for me because trading is one of the things where I eliminate the issue and then validate with confirmation second. And that's based upon knowing that if structure is unclear, then high probability is non-existent. And that can be a combination of elements. Any one unanswered question increases indecision, and indecision will increase your losses. So all in all, this process just makes me very selective, not hesitant. Because anytime I'm monitoring what's going on, most charts will fail at least one of the questions I presented. And if that's the case, then I don't have to take that trade, because waiting is much cheaper than forcing entries. And ultimately, this is why disciplined traders, they survive volatility cycles while others reset accounts over and over. So if you're a new trader, definitely keep these questions in mind and label the confirmations and the invalidations. That way patterns can become obvious very quickly, because the faster you get past that learning curve, the easier it is to remain profitable. But the biggest takeaway is just to be prepared for any interpretation to the upside or to the downside. Because all in all, these questions exist for me because price behavior will not change. Only participation and speed has that ability. So traders who slow their decision making before entry often execute faster and more focused during the move. Because one thing about discipline is definitely not restrictive. So if you can get to the point where you eliminate bad trades, you'll only ever preserve the good ones. Trust me, y'all. So yeah, y'all, that's pretty much all that I wanted to discuss. And with that, that'll just about do it for this video. Y'all already know, if you found any of this information beneficial, feel free to leave me a comment down below. As always, I thank y'all so much for watching. And of course, I'll see y'all in my next one.